Welcome, welcome. First of all, welcome to our first edition of this series called Should My Money Be Scared? The purpose of this series, there's a lot that's happening in the real estate industry. And what I wanted to do, I wanted to speak to different leaders and professionals of the real estate industry and get their take and also find out what they're seeing and what to expect and get the information out to everyone as much as possible. Today, we have a very good friend of mine. He's a lender with Atlantic Coast Mortgage. His name is Scott Eisgrau. Let's bring Scott on right now. Let's see. Are you there, Scott? Scott, can you hear me?
I can hear you. Can you hear me now? Can you hear me?
It's a little delay, but it's fine. I can hear you.
Okay, cool.
How are you?
I am well.
How's everything?
Everything's
There you
good.
go. I'm great. Yes, yes. So, well, first, as I was explaining, before we even start, let's get something out of the way that Scott and I found out today. Okay. So look at the screen, Scott. We are not brothers. This is not my older brother. So let's get that out of the way right now. Well, yes, this is my very good friend Scott Eisgrau with Atlantic Coast Mortgage. And first, tell everyone a little bit about yourself, Scott.
Well, I cut my own hair. Let's start there. So I'm with Atlantic Coast Mortgage. I've been in the mortgage business since 1990. Thought I saw it all, up until the last 30 days or so. I really thought we've been through it all, but the more you think
Right.
that, the more things change.
That's real estate for you, right?
Yes, sir.
Just when you think you haven't figured something changes in the whole landscape of things. Let's get right into it, and we're gonna ask our question to get the conversation moving because we speak a lot about these different things. Just based, have you seen the change in rates? How are rates looking right now?
Rates are really good right now, actually. So we've been through a lot. What we've seen is we had that refi boom that lasted about 10 or 15 days. And then the demand just outweighed what the capacity. So lenders started raising rates because they couldn't handle capacity. And then with the coronavirus, there were all sorts of factors that really, really changed the landscape of the mortgage market. How the stock market crashed. Well, pretty much the mortgage market did the same thing. But it looks like they're working it out and they've got it pretty well under control. And a good buyer today is getting something, in the very, very low threes.
Okay. And just real quick, for those of you that's on the line, if you want to comment with Facebook, even if you want to chime in, please let me know. Leave your comments and we can put them up on the screen. Or if you have any questions, we can put them up on the screen for you. Because I know now, going back to rates, I know we were having a conversation before because of the fact that a lot of people were confusing some things regarding the rates, the stock market going down, which it meant that the rates would be affected by that. And then I saw where we were talking about that, and that's not to be true. Can you explain that a little bit?
Sure. So typically when you think about an investor, someone who's going to put money into investments, you've got stocks and you've got bonds. So typically they're choosing between stocks and bonds. Well, when the stock market's good, people put their money in the stock market, and the bonds need to become more attractive and pay a higher yield. Well, a lot of bonds are mortgage-backed securities. So if they're paying a higher yield, they've got to get more in, which is interest rates. So they were, if the stock market's good, rates weren't as good, and vice versa. But right now, we're totally disconnected one from another. So they're not playing off each other at all right now. And there's a lot of factors that go into that. Forbearance, because now if people can get a forbearance, then the mortgage company doesn't get paid. So what do they want to buy mortgages for? You have other factors, right? Like the 10-year treasury, which is the biggest indicator of rates. And right now it's totally disconnected. But with all that said, rates are pretty much as low as I've ever seen them. As long as you're looking at a conventional rate.
But just to be clear, there's misconception regarding the stock market goes down, then rates go down as well.
No, actually, typically it's the opposite.
Would that be safe to say?
No, typically it's the opposite. But now they're totally disconnected. There is no stock market going up, mortgage rates going up with it. Stock market going down, mortgage rates going down with it. It's not really the case right now. Now they're both down, but not for the same reasons, not for your typical reasons.
Right. Okay. And with that being said, what about any lender requirements? Have you seen any changes regarding the lender requirements around this whole pandemic?
Absolutely. To begin with, jumbo rates are all but gone. So, if you're listening to this and you were thinking about buying $1 million house right now, is probably not the time. So you can tune out right now. As far as requirements, we've seen, conventional was always 620. FHA, for us has been 600. Now we're seeing 640 conventional, and depending upon the day, 640 or 660 FHA. And they did that because they're tightening up and they're afraid of forbearance, really. They're afraid of the borrower not paying. So they're figuring the higher the credit score, the less likely a borrower would want to default and destroy their credit. And a forbearance at this time,
and that's a term
probably a default.
Right. Now that's a term that we're hearing a lot, is forbearance. Could you please explain what that is to the people that's watching right now?
Sure. So a forbearance is in the past. Let's start there. In the past, a forbearance was, if you don't make this payment, we'll allow you a forbearance and we'll put it on the back end of your loan. And after the term of your loan, you'd owe that money. That's what a forbearance was up until 30 days ago. Since the government stepped in and is making mortgage servicers give forbearances, we don't know what that's going to look like. We've heard that some lenders will put it on the back of the loan. Some lenders are saying that after the forbearance period, they'll give you 12 or 24 months to make back the payments you skipped. So to give you an idea, if your payment's $2,000 a month and you skip 6 payments, and then when you come out of forbearance in 6 months, the lender might say to you, look, okay, so you owe us $2,400 because you owe us $1,200, you skip 6 months. Okay, so for the next 12 months, instead of $2,000, you pay us $3,000. Or for the next 2 years, you pay us $2,500 instead of $2,000. And that's a very real possibility. The other part of a forbearance is that the lender has the right to mark you late. So Wells Fargo's already come out and said, if you don't make your payment, you're late. We may not be foreclosing, but you'll be 30 days late the first time you miss your payment, 60 days the second time, and so on. So, that stays on your credit report for 7 years. So if you have a 30, a 60, a 90 on your credit report, you're not refinancing for 12 to 24 months after you're caught up. My best recommendation, if you need a forbearance, okay, or you're thinking about a forbearance, call your lender. Call the person that sends you that mortgage statement and find out what it's going to look like. Don't just not make your payment. That would be the worst possible thing you could do. Find out what it's going to be. If you're still working, then the mortgage should be the first thing you pay.
Definitely, definitely. Now, with that being said, since we're talking about the lender requirements and things of that nature, um, because of this lending requirements are tightening, is that do you see that being the case after everything is over, or what will be the new norm in your opinion?
So we really don't know the answer to that. Everything that we're getting says for the near future. So what I'm being told through my employer is that for the near future, these are the new credit scores. For the near future, this client will need reserves. One of the things we're doing is we're asking all self-employed borrowers to sign a statement about what they're doing right now, what their income is, how it's derived, if they're still working. And then at closing, we're asking them to sign another letter that says they understand that they're buying a house in a pandemic and that they do expect to make their payments moving forward, based on their current situation. So things are a bit different.
Okay. And
so I didn't
know
really
we have this conversation a lot. Look, and that's and that's an honest answer, because here's the thing: we really don't know.
We don't
a
know.
lot. What's happening right now? Right. What's happening right now? We're looking at 2000. And just real quick for everyone who's just joining, this is Agent Cory Banks, Realtor 007, and I am speaking to my guy Scott Eisgrau with Atlantic Coast Mortgage, and this is a new series called "Should My Money Be Scared?" And right now we're discussing some of the things that the things that the real estate industry is starting to see, and to see if we can kind of figure this whole thing out, but at the very least get information out to everyone. But back to what I was saying in regard, we really don't know, because we've never seen anything like this. I believe nothing has happened like this since the Spanish flu, right? And I don't think any of us were around that time, especially us doing real estate, right? And a lot of people are looking at 2008. Okay, time we had something crazy happen, but the problem is this is not 2008 situation, and that's an honest answer. So I appreciate that.
Right. So in 2000,
and I guess with that question, say it again.
I said in 2008, it was an economic crisis. We had problems within the economy, right? The economy started to grow. House prices went up 30-40% leading up to 2008. And then we had an issue where it was the economy that caused it. Right now, our economy was rolling. Right. So there's no reason to believe that our economy won't get back within 6 to 12 months back to where it was. It may be a different landscape, but this wasn't due to any financial issues. It's due to a liquidity issue where, money's not rolling out. And I think that's why the government's giving us, all these different incentives to small businesses, to individuals. So I don't think that this is anywhere near the same.
Definitely. I mean, we're all trying to figure it out at this point, which is just a very interesting time that we're in. I know we were speaking earlier about whether or not it's a seller's or buyer's market, and yeah, we had a very extensive conversation about that. What's your take on it?
Well, before I spoke to you, and I kind of still lean towards it being a buyer's market. My feeling is if someone's got their house listed right now, you got me? If someone's got their house listed right now, and they need to sell, I've seen a lot of listings come off the market, and the ones that are left want to sell, need to sell. And I think that it's a great opportunity for a buyer to go out there and get a good deal. You know, I don't think you're stealing anything, but I think it's a good deal right now.
Okay. And again, if you guys have any questions, any comments, please please leave your comments and we can put them up and get them answered for you, or at least find out with the conversation that we're having. Me personally, I also had a conversation. I had the same conversation with a very good friend of mine, Danny, who's an agent in my Keller Williams office. And as we're talking, my thing is, I think it's going to end up being a balanced market for a little bit. And it's not going to be a seller's market. It's not going to be a buyer's market. It's just going to be kind of in the middle, to where you're not going to overly price or overly pay for a house, or you're not going to be able to underbid and get it. It's going to be kind of even one, because at the same time, what's going to happen is, even though people still need to sell, time you're going to have a little more inventory on the market. But also with that, you have people that's out of work right now, and people, they're going to need to get back, but you're going to have that influx of people. So I think what's going to happen is going to end up being a balanced market, but then it's going to, I believe, is going to lean back over being a seller's market, because of the fact that, you know, it's like people in the house, they're ready to go and they can't do anything, and they're going to be ready. So I think it's going to end up being the seller's market, but at some point there's going to be a balanced market coming out of it.
Right. I don't disagree at all.
And
I think that as far as when I say buyer's market, I'm leaning favorably towards buyers, but I'm talking about less multiple offer situations, just more advantageous for a buyer right now than a seller. And I think you're right. It's going to be balanced. I don't think you're stealing anything. And it will go back to be a seller's market. There's no doubt. Before we started, I was talking to you about Flagstaff, Arizona. There, it's a seller's market. Even through coronavirus, prices are going up.
Yeah.
Inventory is going down. It's crazy.
And people always ask that question of, well, how's the market? And we just have to answer first. It depends on where you are, number one, and then what side you're leaning towards. Because my thing is mainly investors, and we have different conversations with that all day.
Right.
But even in this, like a place like Flagstaff, Arizona, like you said, is a seller's market. I think you were telling me that housing prices went up in Flagstaff, Arizona, right?
Yeah. And it's interesting because the iBuyers are gone. Flagstaff was a big iBuyer market, and all the iBuyers have pulled out of the market right now. So even with them gone, it's still a seller's market. It's unbelievable.
And explain what to the people don't know. To the people who don't know.
Okay.
To the people who don't know, explain what an iBuyer is.
Sure. So iBuyers are groups that buy without seeing the house. So to give you an idea, Redfin has an iBuy program. So does Zillow. There are a lot of big money players in that space. So what it is, you go online, you take some pictures, you fill out a form, and they'll buy your house sight unseen. And it's no deal, because you're paying a fee. They're giving you just under market, right around market, but you're paying, for a 10% or an 8% cut. And then you still have your seller's closing costs, but they're buying it now. So, if it costs you an extra 2 or 3%, that's the way it'll work out. That's your iBuyer.
Okay. Now, I just want to make sure that people know some of the terminology, because everyone's not in real estate. So I just want to make sure.
Sure.
And again, if you guys have questions or comments, please leave your comments and questions, and we can put them up for you and get them answered. In regards to the loan process, by any chance, is you see loans taking a longer time to be processed, or
Okay.
or is it still normal? What are you seeing
Right now?
Correct.
So right now we're still closing purchase loans in 30 days or less. That's bread and butter business for us. The refis can go away, when rates go up. So right now we're still doing purchase business in 30 days or less. We're doing refinances. We're taking 60 days to do those, but we're locking the rate in and we're good to go. So the question really is more, where are we going? I will tell you that my company's done a fantastic job transitioning to home. So for me, it's easy. I've always had a setup at home, and I can always work from home. And I think I'll probably work from home more moving forward than I ever did before. But, my underwriters, the processors, the closers, post-closing, compliance, everyone's working from home. Those people are people that are used to sitting in an office. So, if they have kids and now their kids are home,
Right.
it's creating a lot of issues within, but, hopefully other mortgage companies are doing as well with it as we are. And we're just getting through it. So if you're purchasing right now, no difference in turn times. I mean, I'm not doing 15-day closings, but I can certainly do something in, 21 to 30 days. And then on the refi side, we're just locking, and, right now we're closing those loans in June.
Okay. Actually, I have a question. Hey, Makola, have a question from Makola Brooks, and she's asking, what's going on with MMP?
MMP is probably the greatest option right now, especially if you're an FHA buyer. So we were talking earlier about bonds and great rates. So the Fed came in and they're purchasing all the mortgage-backed securities, but they're buying the conventional. So the Ginnie Mae, which are governments, aren't being bought, and those rates are really not the prettiest, but MMP has held their rates. So MMP is working from home. I've closed maybe 3 MMP loans since we've went down into lockdown. They're doing a great job there as well. And their rates are fantastic. Their rate with their 3% interest-free loan, the last I looked was 3.5 or 3.6. And they'll give you a loan of 3% of the purchase price that you can use for your down payment. And in essence, almost have a no down payment purchase. 100% financing.
Okay. And just real quick, what's up, Frank? What's up, Tony, Hassan, Shanika, Danny, and whom else? And actually, Shanika, her question was, what is the market like? So I think we kind of took the question already.
Crazy. It's absolutely crazy.
And let me see. It says nothing we've seen before. Give me 1 second. Make sure I don't have any more questions over here before I move on. Okay. What do you think the new normal will be? I mean, based off of what was happening right now, what do you see the new norm in lending? Based off of the trends and outside of staying home and working.
I was gonna say no more handshaking, all that kind of good stuff. But I think that
right.
Yeah.
Right.
I think that as far as lending is going to go, I think that we're going to see it go almost all the way back. What we've always seen in lending is a pendulum. So, everything was loosey-goosey in the early 2000s, right? Someone who was a janitor could put that they made 10 grand a month on their application, and you'd sell them a $10,000, $500,000 house, and I'd lend them 500 grand on 100% financing back then. So when the market crashed,
wait, back up. Hold up. Wait a minute, Scott. So I could have told you I made $10,000 and brought a $500,000 house.
Oh yeah. That's what caused the problem of the bubble, right?
Okay, back in
right. So what happened after that is instead of just shutting it down, we made it very difficult to borrow money in 2008, 9, 10. Okay, but by 2011, things were much easier. So I really think that we may stick with some of these guidelines a little bit, but it's coming back. You know, I don't see that there's a weakness in real estate, right? Or in the way we're financing people. You know, this is a virus that put a lot of people out of work. So hopefully those people will get back.
Right.
And I think so will the mortgage industry. But just to be clear, Corey,
what's your time frame on, let's say, your time?
This delay is killing us.
You said just to be clear?
Yeah, just to be clear, the I don't know the right way to put it. That it's not that far off as far as guidelines now than it was a month ago, right? It's credit scores, it's reserves. So good buyers are still going to be good buyers. Okay. It's the one where they're squeaking by, where you know they may not get a home now that they would have a month ago, and will again as soon as we beat this thing.
Definitely. I mean, it's a an interesting time that we're in right now. How can everyone get a hold of you? How can they get in contact? Actually, I'm gonna put your information up on the screen, but you know, just talk.
Right. So, you know, again, I'm Scott Eisgrau with Atlantic Coast Mortgage. My cell phone number is 410-977-1201. And my email is scott@lowrateloan.com. You know, and I'll tell you what I tell everybody. Call me whenever you want. I promise if I don't want to talk to you, I won't answer the phone.
And well, first, shout out to my man, Eric Stewart, who has a question as well. How about FHA, pricing for FHA?
It's ugly. Eric's a lender, isn't he?
I know some of those things have changed as well. Yes.
Yeah, Eric. I wonder what's Eric's rate on FHA? Maybe I could send it to him. You know what's happening now.
What do you get?
I don't even look. That's how unhelpful they are. I mean, I can look them up now, but they are not pretty. Not at all. So the government is buying all the mortgage-backed securities. They're the only buyer, and it's conventional. So the Ginnies, which are government, are really, really struggling. So why don't you talk, and I'll look up FHA rates for our friend Eric.
Yeah, because I know some of the guidelines or requirements with FHA that they were tightening up a little bit, because we went from like a 620, and some of the lenders are asking for credit scores of between 660 and 680.
Yeah.
And I think JP Morgan was JP. I can't get out. JP Morgan is what I'm trying to say. Is now asking for like a 700 credit score when it comes to loan. So definitely, FHA they're tightening up their requirements. And I keep asking this question: do you see that being the norm after this, or do you see that going back to the 620 credit score, some of the documentation that we're looking for? What are your thoughts on it?
Thoughts are, I'm not wearing my reading glasses. No, I think it's going back. I don't think there's any reason not to go back. So yeah, I would think that they're definitely going back. Do I sound like Rain Man?
And I see Frank also, my man Frank also commented. He said basically it's going to get worse before it gets better. I can respond on the real estate side, but I will prefer you respond on the lender side. Will it get worse before it gets better?
No, I don't think so. I think okay, so I shouldn't say that. I'm a half full kind of guy, so I want to believe it's going to get better. I think that we've been through the worst, but the big issue is going to be is how they handle opening back up the country. If you open the country back up too soon, then we're going to go through this again. And yeah, then it'll get worse before it gets better. But I think if, the guidance that we get is shelter in place for as long as we need to. I mean, I've been doing this a month. I'd hate to go back out in public and then get stuck in the house again for a month. So, that my feeling,
Right.
yeah, so that's my feeling is that.
And have a question.
Yeah.
I have a question from Shanika. In regards to statement loans for business owners, people who are out of work right now and they're still looking for homes, what advice would you give to any business owner who is who's looking for a home right now?
So we do have this bank statement loans, but I don't believe they're available right now. So the term is non-QM, and there's really nothing in the non-QM market today. So that stuff is hard because that money doesn't come from Wall Street and bonds. It comes from hedge funds and it comes from private investing, not like when you guys deal with, like a Truist or whoever around here, but big, like Blackstone private investing. And that money's dried up right now. But it'll be back. It'll be back.
Okay. And also explain that, because we spoke about that as well regarding the investors who are purchasing those loans and why rates have to go up, why the requirements have to go up. Explain why that happens so the people can understand.
One more time. I'm sorry. I was looking at the rates for Frank.
You're still looking for the rates?
I found them, but yeah.
We were talking before about not good, huh? We were talking about the investors who purchase those loans and why rates go up, why requirements are tighter, and things of that nature.
Okay.
Explain to the people exactly that process, and so they can get a better understanding of why the rates or requirements would tighten up in situations like this.
Sure. Okay. Before I do that, Frank, we got 3.5 today. FHA, no points. I could be at 3.25 with like a quarter point. So FHA is back. Looks pretty good. It's pretty exciting. Thanks, Frank.
Okay.
Let me know. All right. So okay. When you have a mortgage,
it's back, gentlemen.
Yeah, it looks like they're good. I haven't looked at one. All right. So when you have a mortgage, and when a lender makes a mortgage to a client, the lender is going to sell that mortgage. There's really two parts to the mortgage. The first part is the mortgage itself, which gets put in a mortgage-backed security and gets locked up, wrapped up with 100, 1,000 other loans and becomes a mortgage-backed security. That goes to Wall Street. Well, that pays dividends. So someone has to collect the money, account for the money, subtract it from what someone owes, and then pass the money along. That's called a mortgage servicer. The mortgage servicer is who you think has your mortgage, right? I pay Wells Fargo. So Wells Fargo's, my mortgage company. They're my mortgage servicer. Some pension fund or, union owns my mortgage. But we'll never know who owns it, nor should we ever really care. It's just who we're paying. Okay. So when we sell the loan, we're selling part of it to the mortgage-backed security and the other part of it to a servicer who's going to account for it. So the problem came in with servicing. So when the loan gets sold to a servicer, let's say they were paying us 1% of the loan amount. So on a $300,000 loan, they were paying us $3,000. And then when they pay out to the mortgage-backed security, over the year, they're going to keep about 33 basis points. So they have 3 years before they're going to break even. So what they'll typically do is pay half of it and borrow half of it. So they're going to pay the lender 50 basis points plus another 50 basis points that they borrow. So when this happened, and it goes back to forbearance. So the government said it's going to be okay not to pay your mortgage. So that really devalues what the servicing is worth. And immediately servicers said, we're going to pay you half. Okay, we're not paying 100 basis points. We're going to pay you 50 basis points. Now, the people that were lending them the other 50 basis points go, whoa, 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 whoa. The value was 100 basis points and we lent you 50%. That's a safe investment.
Mm-hmm.
Now you're saying the investment's only worth what we're paying for it. We want our money back. And they started to call their loans. Well, that's a major liquidity issue for the servicer. On top of that, or the reason for that, is the servicer still has to pay the principal and interest back to that mortgage-backed security, whether they get paid or not. So in the past, out of 100 loans, maybe 3 or 4, at any point in time were late or didn't pay. Okay. And they can manage that. But could you imagine if it's 25% of their portfolio? Where are these big services going to come up with the money to push it through that isn't coming in? So they really got squeezed.
Right.
And eventually they came to lenders like us and said, you know what? You want us to service it, you pay us. So that's why we saw this huge jump in rates, and we needed the Fed to step in and tell the servicers they're going to be okay. And I think that's why we're seeing a stabilization in rates today. That's a long answer to a short question.
Okay. It's all right. That's why we're here. And again, for the people who are just tuning in, is why should my money be scared? This is a series of where we're speaking about different things that's happening in the real estate industry. And today we're speaking to Scott Eisgrau and of course Realtor 007. And it's just putting the information out. So we kind of have an idea of what to do and where to go. Now, in regards, have you seen a decrease in your activity, or is it still?
I didn't get that. Could you try again?
It's still kind of the same. What does your activity look like?
Well, it depends when we're talking about. So for the end of March, the end of February, the beginning of March, were 12 and 14-hour days for me, right? We had that mini refi boom, and I've learned from the past, they don't last long and they go away as quick as they come. So, I worked really hard through that period. And if, I'm nowhere near where I was in that period. But I'm still getting purchase contracts in, and, I'm still scheduling purchase loans for now. I'm probably into May, but, last week I put something up for the end of April. So yeah, I'm still busy. The refi rates, while they're not quite the same as the purchase rates, on a 30-year fix to get 3.25 or 3.3%, on a 15-year to get 3% or better, rates are great. So yeah, I'm seeing a lot of refi business. If, anyone listening who needs to refi, they should give me a call.
Which is my next question about refi.
Right.
So basically what you're saying is now for the current homeowners, now would be a great time to refi.
Well, think about it. You get an automatic 1 month forbearance. So when you refinance, if you closed your loan today, okay, you're not going to make a payment in May. Your first payment's due in June. And then you're also going to get back any money that they're holding in your escrow account. So you skip a month's payment and you get your escrow money back. I'm working on a loan now. Right before we got on the call, I was working on a loan for a lady where her windfall there is 10 grand. So she's got a $3,000 mortgage payment. She's going to have 7 grand in her escrow account. So not too shabby.
Let's back up for a second for the people that own their homes right now.
Right.
I don't know if they saw, if they heard what I heard, but I have to make sure that they understand. Okay. Now, what you just said was, if you currently own a home right now, let me see if I can break this down. If you currently own a home right now and you were to refinance, because of forbearance is a possibility, or you could get the 1 month without payment. Did I hear that correctly? Or
right.
Tell
It's
me I'm
not.
wrong.
I was making a joke. Okay, so it's not forbearance.
Oh,
What it is you skip a month's
bro, we
payment.
gotta be clear.
Right. I'm sorry.
Exactly.
No joke. Okay.
You have to be clear.
So
Right.
if you were
they're not looking for me.
when you close in April, you don't make a May payment. Your first payment's in June. If you close in May, you don't make a payment in June. Your 1st payment's in July. So you skip a month's payment. That's where I was joking with forbearance. So you skip a month's payment, and then any money sitting in your escrow account has to be refunded to you within 30 days. So, that's got to be right now. You probably have in there 4 to 6 months taxes and homeowners insurance. Could be a significant amount of money you get back. And then we finance it into the.
We have a question. Question from Shanika. She says, when you refi, would this be the start of your ownership? What she's saying. If I had my home for 3 years, I will lose the 3 years, start over. So basically what I guess what she's asking, if you were to refi right now, would that restart the 30, if you're a 30-year mortgage, would that reach years?
Yes. But I would answer it like this.
Now,
I feel as if there are 2 things I'm always going to be paying. I'm always going to be paying a mortgage payment. I'm always going to be paying a car payment, right? So, 27 years ago, because that's what you got left, Shaniqua, what were you doing? Where were you? Was your life the same or different? So, yes, you're adding 3 years, but in a lot of cases, if you took the money you saved and put it back towards your payment, it would be a principal payment. You would probably pay it off faster than you would as a 27-year loan. So you might pay it off in 26, 25, 24, depending on it. The way I measure savings on a refinance is we take the cold hard costs, right? That's your title fees, your lender fees, and divide it by your savings. So a typical refinance is about $3,500. So if you save $200 a month, you're going to make that money back in less than 18 months. That's a pretty good turnaround, right? Especially when you're talking about having a home for, 10, 20 years. So that's how I try to show my clients what the savings are, if that makes sense. But yes, you are restarting a new 30 if you choose a 30.
And in most cases, because I'm gonna put my investor hat on real quick, right? And in most cases, when you're refinancing, a lot of times is to reduce your payment, correct?
Correct.
And then, well, she's only 3 years and have equity, but for the people who have owned their home for a good number of years, if you have equity in that property and you refinance, if you're pulling that cash out, as again putting my investor hat on, pulling that cash out and putting it into another vehicle that's going to make money, then at that point, that extra 30 years or restarting over wouldn't really matter, because it puts you in a better position.
Right. So
have another question from, okay, go ahead. Scott, can you hear me?
Yeah, here.
You were saying something. Go ahead.
Oh, what I was saying is, it's a bite your nose to spite your face kind of thing. I can save $200 a month, but I want to lose the 3 years. Well, you don't want to bite your nose and not take the savings if it makes sense, because you're going to add 3 years on the back of the loan. It's sometimes, like, I've done a loan for someone, and 6 months later the rate's significantly better and they lose their closing costs. But you're better off losing the closing costs than not taking advantage of the upside. So you have to weigh the upside versus the downside. That's all.
And we have a question from Frank regarding the cash out refi on the rental property. Is now the right time to do it?
It depends, I guess, on what you need the money for. But yeah, I mean, rates are good. So on a cash out refi on a rental, we can go up to 75%. So depending on, how much equity you have in it, what you need the cash for, those are more of personal decisions. But in a rate market, you're not going to find a better one.
Okay. And please keep the questions and comments coming if you have any questions. And of course, that's actually a strategy that we teach when we're speaking to my meetup groups and things like that, which is the Burr method. I don't know if you're familiar, but buy, rehab, rent out, then you refinance to pull that money out, and then you repeat the process all over again.
Right. I like that.
And based off of what I just said, I feel like I just answered the next question for Frank. Also, with Shanika has another question. What is the credit score for a refi for a rental? So if you have a rental property and you want to refi, what is your credit score has to be?
That's a good question. I can look it up. But typically, especially with rentals, when you're paying the hit for being an investment property, the better your score, the better. So let's take a look. We want to do a cash out, right? Keep making me put my glasses on.
Right.
I see so much better with my glasses.
So we have two people that keep the glasses on, man. And again, this is not my older brother. We just look like that on TV. Any other questions? Okay. Frank is giving the thumbs up. Now, what about one thing we talk about a lot, and we talked about this at Real Estate into Retirement, which a lot of people don't know. And surprisingly to me, I guess a lot of people don't know regarding buying a 4-unit property. Anything 4 units or less is still considered a single family home based off a mortgage. Can you talk about that a little bit?
Okay, so yeah, what I talked about at the last seminar was if you could buy up to a 4-unit property, you could live in one of those 4 units, and you can do 3% down, 3 to 5% down, 3.5 to 5% down, and loan amounts up into the like 700s. So crazy stuff. If you're a first-time investor thinking about wanting to buy something, a multi-unit property is a great way to go. You're literally right there to protect your investment. You would know more about that than I, but because it's a primary residence, you get primary residence rates.
Now let me break that down on the investor side. If you're a first-time home buyer, I mean, you don't have to be a first-time home buyer, but if you go to purchase a home, and most people think about single-family homes as far as the purchase, and I can get but if you anything 4 units or less, you can loan you will get as if you were to purchase a single family home. And the reason why that is significant is because you can live in one of the units and rent out the other units. So now what happens is if you're renting out those other units, now let's say it's 4 units, the other 3 units are actually paying your mortgage through way of paying their rents. And now, and it's almost like you're living for free and getting paid for it. Then refinance or do whatever you're going to do. At some point you may want to move out. Now you have all 4 units rented out, and now you have a fully cash flowing property, and move on to the next thing. And it's under the same guidelines that you would have if a normal single family home.
Right.
Yes, that's called house hacking, Frank. Yes, thank you.
I like that. Oh, cash out investment property 660 credit score.
So we're at 660 for a cash out refi on a rental property.
Correct. But again,
And
better credit scores,
let's go,
better deals.
right. And let's go back for a moment, because you have people who are confused, thinking that the FHA requirement has gone up. As far as that's only certain lenders. Every lender is not required to require a 660 credit score or more. The requirement for credit scores for FHA is still 620. That has not changed. Just the lenders themselves
are
making. Oh no, 580.
FHA.
Was it 580?
No, FHA.
I always say 620.
Okay, so FHA doesn't put a credit.
Wait a minute. We talked about huh?
FHA doesn't put a credit score requirement in their program. FHA does not have a credit score requirement. It's the lenders. The only requirement that FHA says, if you're 580 or lower, it's a 10% down payment. Okay. But other than that, there are lenders out there that do FHA 530. It's just not the market that most lenders are in. Yeah, they get very ugly. So, we went from 600, I think, to 640, but I'm going to run it again right now just to make sure that I'm not 660. FHA purchase.
Yeah, like I say, you learn something new every day, because and I'm pretty sure some of my other agents that's on live right now have learned something as well, because we're normally, the way we're taught, or we think about it, is 580 will be the very bottom, but we want to get at least a 620 to purchase a home.
Okay, so
that's great information. So,
right, but you're not finding many lenders that are going to go that low, and then you'd be hard pressed to find a buyer that's got a 540 credit score that can put 10% down. So it's like it's not really there. We're a 600 FHA lender typically, right? Some are 600, some are 620. That's internal set. So with FHA, the mortgage company, they track loss ratios. Okay, foreclosures, late payments. FHA has been tracking that for years, and you get scored. And if your score gets too low, you can't lend FHA. So the way we protect our scores is by cutting a line in the sand of where we're going to lend to buyers if they're using FHA, if that makes sense.
Right. Okay. And hey, Tammy, I see that you're on live as well. That's big sister Tammy. That's Charles's wife.
Okay.
So if she's watching, more than likely she's watching too. Before we end everything, is there anything else that on the lending side that you think that we to know or be aware of as we move forward in this whole pandemic that we're in right now?
So I'd like to start by saying that everything's going to be okay, right? Stay inside, stay healthy, stay safe, convince your friends and family to do the same, keep your parents indoors, very important. But I think everything's going to get back. I'm an optimist, but I really, truly believe that our environments are going back to normal. And the other thing is, I'm a now guy. So when people say, should I buy now or should I wait till next year? My answer, if they can qualify, is to buy now. Stop throwing your money away, right? Make someone else rich. You look at all the people that built this country, the Rockefellers, the Carnegies. There was a series on TV, The Men Who Made America. They were all real estate barons. They all bought real estate. What other investment can you buy with a minimal down payment and have the entire investment grow? Buy now.
Right. Buying hard assets. You need to tell me where to find that series as well. You check that out. But yeah, definitely buying hard assets, and in most cases is going to appreciate, or if it doesn't, it's always some type of value when you're looking at real estate. But the question is how to find that value. Again, looking on the investing side, you have a few things. Either you're gonna have value in equity into that property, or you have value in cash flow into that property. Which means that if I don't have if the property is not worth a lot, or if I owe a little more than what the property is worth, if I'm right there, then at least I have the cash flow where I can rent it out or something like that. And so there's always value to be had in real estate. You'll know how to find it. So I definitely agree. Just make sure we don't have any more questions or any more comments. Let's see. And again, I'm gonna put information up screen for you guys. If you're looking for a loan, if you're still looking to buy, Scott can definitely take care of you. I put his information up on the screen, so please write it down and get in contact with him if you have any more questions. And
Cory, thanks for
first
having
of all,
me.
thank you for being on the broadcast with me, Scott. I appreciate it. No problem, no problem. And this is gonna be a series. The next broad Wednesday, and we have a surprise guest as well, and it's gonna be Wednesday at 4 o'clock. And if you guys have any questions or if you want to get in contact with me as well, give me a call at 443-380-0182, or you can email me agentcorybanks@gmail.com, or you're already on my live, so you can always send me some type of inbox message or something like that. No problem. And again, Scott, thank you. I will see you guys on Wednesday at 4 o'clock. And we'll have some more information for you. We'll have another guest to speak about this whole thing dealing with COVID-19, and it's called Should My Money Be Scared? Again, thank you guys for coming, for joining, and have a great day. Be safe. Stay in the house.
Take care.
Stay in the house. Thanks, Scott. I'll talk to you later.
Bye-bye.
Oh, I got to end it.